Tom, welcome to the programme. Let's start with housing inflation. And let's start here. Provocative question, I know. How big is the spread between shelter as measured in some of these indexes that we read inflation and the real world? How big is that spread?
Thanks so much for having me. It's big. So just to put it in perspective, shelter is 1/3 of CPI. The Fed the CPI numbers are showing up 5.2% in June. That is just not the real world. So CPI is at 3%. If you include housing CPI, it's at 1.8%. We own a lot of rental property. I can tell you that shelter is definitely not up 5.2%. It's flat to down. So why is that? So shelter really has two components. One is what's called owner's equivalent rent, and the second is actual rent. So 3/4 of the shelter component is owner's equivalent rent. So how is that determined? So they basically call people up and ask, if someone were to rent your home today, how much do you think it would rent for? Now, let me ask you a question. How many people really know the answer to that? I certainly don't. And so obviously you have a lot of miscalculation in the shelter number. So again, if you took shelter out today, we'd be below the Fed target of 2%. We'd be at 1.8%. It's definitely delayed. And there's no way that shelter costs are up 5.2%. So we'll see over the next 3 to 6 months that shelter number coming down to zero. And we'll definitely see CPI coming down to that level because of that. Because again, 1/3 of CPI is shelter.
So Tom, help us with this. Do you think we're past the cyclical bottom in real estate already? Is that behind us?
Yeah, we're already starting to see some signs of that today. Look, we've seen tremendous impact in CRE pricing. So overall valuations are down 21%. Office, of course, is the worst of that, is down about 37% to date. And that's, of course, because of the demand shock given work from home. And if you look at office in, say, San Francisco, Chicago, New York, the B buildings there are down 60, 70%. So we are already starting to see people anticipating a increase in pricing. So we're starting to see what cap rates are, which are what the investor expected yield is, already starting to come up in some of these markets. So cap rates starting to come down. So pricing is starting to come up, particularly in multifamily. So, just to give you a perspective, multifamily, you could have traded a B multifamily 3 years ago for 3.5% cap rate. Today, it went to about 5.5%. We're starting to see it come down 5.25% today. So it's really not a huge amount, but I think we're starting to see it come back. But, you also have to look beyond just interest rates. Of course, you have other factors as well. As I mentioned, you have work from home issues from the office perspective. You have expense issues. Certainly insurance has come up dramatically, taxes. Of course, wages are factoring in. So we're starting to see OpEx issues in some of our properties. So there's obviously more to it than interest rates, but interest rates are a huge component because if you had a floating rate loan, your cost of your mortgage just doubled.
And Tom, you point to particular markets that have benefited pretty dramatically during the pandemic, whether it was Florida or Texas, and how you've seen a real flattening out in terms of home price values, as well as an increase in builder incentives to bring people in to new constructions. There is a theory out there from a lot of people who join us that as soon as the Fed cuts rates, this all reverses. You start to see that pricing pressure once again reassert itself because there is just so much demand and still a chronically undersupplied housing market. Do you agree with that?
Somewhat. Interestingly, home building has been the darling, and it's gone through the whole downturn without unscathed. And that is, of course, because there's very limited supply, because if you have a 3.5% mortgage, you're not selling your home. So the amount of homes on the market are less than 1 million of existing homes. So that's been the issue. But so it's a little bit of a double-edged sword here, because on the one hand, if interest rates get cut, it's obviously positive in the sense that it makes housing more affordable to buy. But in the other sense, you're going to see more inventory come on the market. So we are starting to see, actually, for the first time, a little bit of weakness in home building. I don't think it's going to be dramatic, but incentives, as you point out, for example, in Texas and Florida, are now at about 6.5% versus what they were at 4.8%. And mostly what the home builders are doing is they're using, basically their playbook has been to use the incentives to buy down mortgages. So if you buy an existing home, you're paying 7% on your mortgage, but through a home builder, you pay 5% because they're buying down the mortgage for you. Because people obviously look at what their monthly payments are and what they can afford. So I do think that it's not going to necessarily mean that home building is going to shoot right back up, because it's been such a dramatic, really positive market for so long now. I mean, we've been seeing this for over a decade, and it's been our largest investments to date. So we're certainly not stopping investing in home building. In fact, we really like the sector a lot, but I do think we'll see a moderation a little bit.
Just to put this all together, Tom, when you first started talking about how you expect housing inflation, renter's equivalent rent in the real market as basically falling to zero at this point, or very close to it, or at least in that direction, it would argue for rate cuts, that essentially this is restrictive policy and that it's actually reducing inflation more than some people would estimate. But when you then talk further about just how much there could be renewed bout of inflation with home prices going back up as soon as the Fed cuts rates, it raises a question. Is that basically what you're arguing for, that this is basically a sufficiently de-inflationed economy, the Fed can cut rates? Or is it just highlighting the dynamic and how sensitive the housing market really has gotten at this point to rates?
Well, keep in mind, home prices are not in the CPI because it's viewed as an investment. So again, it's rent that is. So just because home prices go up doesn't mean your CPI goes up at all. So I do think, again, there's going to be a little of a push-pull here in the housing market. It's been so strong, but if rates keep coming down, now I'm not talking about a 25 basis point rate cut, because who cares? But if we start seeing dramatic rate cuts, you're going to you see a lot of people who actually want to sell their home, but how do you sell your home when you have a 2.5% or 3% mortgage? And that's been the real hang up here. So I'm not quite sure it's going to play out that way. I think we're going to see a pretty good housing market, probably not as good as people think it's going to be. And I don't think that means that housing prices are just going to shoot to the moon now. Again, because we're going to see supply finally coming on the market. We have the most anemic supply we've seen in decades on the market of existing homes. So I do think it's going to change, and we're going to start to see some supply on the market. So that'll counterbalance the demand side.